Affirm, Klarna, and Afterpay. In just 5 years, these three companies have popularized a new form of consumer spending called Buy Now, Pay Later. Buy Now, Pay Later is a type of short-term, unsecured personal loan where instead of paying the full price upfront at checkout, you can defer the cost of any item by splitting the payment into smaller installments over time. If you want to spread out payments over a longer period of time to make the installments even smaller, you'll have to pay interest. And if you miss a payment using Buy Now, Pay Later, there are penalties with late fees, collections, and lowered credit score. The concept of debt and payment plans have been around for centuries. America itself was founded on Buy Now, Pay Later. In the 1600s, the Pilgrims borrowed money from lenders in London to pay for their voyage to the New World. The Pilgrims agreed to a long-term loan with a payment plan of 4 annual installments. While the Pilgrims didn't have to put up any collateral, most ended up dying upon reaching America, so you could say they repaid with their lives. Examples of long-term consumer loans these days are mortgages and car loans. If you miss enough payments, the lender will repossess your vehicle or home through foreclosure. In the 1800s, during the Second Industrial Revolution, short-term personal loans became popular with Americans. Furniture, farming equipment, and sewing machines were investments that were only affordable when paid in installments. These days, short-term consumer loans are typically offered only by select businesses for large, infrequent one-time essentials like furniture or appliances. These loans are generally unsecured and based on your trustworthiness as a borrower, which is measured by your credit score. If you miss enough payments, the lender will penalize you with interest, fees, and collections. What Klarna, Affirm, and Afterpay have done is they've broadened the purpose of short-term unsecured personal loans from large one-time essentials into everyday impulse and splurge purchases. They've made it easy for anyone to borrow money, simplifying a historically opaque, time-consuming process of applications and manual underwriting into a scalable user experience that provides instant credit in just a few taps. With Buy Now, Pay Later, you can afford just about everything you desire by splitting costs into as many tiny payments as you want. Most of all, there's instant gratification. When using Affirm, Klarna, or Afterpay, you can get your order delivered right away on or before your first payment. In 2020, Buy Now, Pay Later accounted for $97 billion, or 2% of the $4.6 trillion that was spent on e-commerce around the world. In 2021, Affirm, Klarna, and Afterpay together boasted over 173 million global active customers. These days, 4 in every 5 Americans use Buy Now, Pay Later on everything from clothing and groceries to gifts and cleaning supplies. Even though the valuations of Affirm and Klarna have been pummeled in recent months, Buy Now, Pay Later seems here to stay even if it doesn't make much business sense. While no one knows if Buy Now, Pay Later is even profitable, companies don't want to miss out. Fintech has a terrible track record when it comes to both idea and execution, like blockchain, peer-to-peer lending, and equity crowdfunding. Yet companies are always eager to jump on fintech bandwagons before the wheels are even placed. Scared of losing their duopoly, Visa and MasterCard have jumped headfirst into Buy Now, Pay Later. PayPal and Stripe have launched their own products, Chase and Citibank have thrown their hats in, and even Apple and Samsung have joined the party. Putting aside fundamentals, Buy Now, Pay Later itself is controversial. To critics and regulators around the world, it promotes irresponsible spending and enables overconsumption. In this episode, we'll explore the business model of Buy Now, Pay Later, its eerie similarities to the 2008 subprime mortgage crisis, and why that matters now more than ever in the coming recession. First, we have to understand the 3 core trends that have led to the emergence and rapid growth of Buy Now, Pay Later. These 3 trends are connected to one another: the growth of e-commerce, the decline of credit cards, and high customer acquisition costs. E-commerce boasts an exceptional runway as only 14% of global retail sales today take place online, while the remaining 86% still occurs offline in old-fashioned stores. But with the death of shopping malls, brands see the writing on the wall for retail. While boomers continue to dominate consumer spending, millennials have surpassed boomers as the largest living adult generation. Millennials are now coming of age, having children, and will soon hold the reins to the economy. Retailers know that if they are to thrive, they have to nail this handoff and adapt to the consumption preferences of each generation before they peak. Millennials and Zoomers are e-commerce power users, with over 70% preferring the convenience, flexibility, and selection of online shopping. In response, retailers continue to optimize every pixel of their e-commerce strategy from storefront redesigns and load times to order fulfillment and checkout experiences. While e-commerce is the future venue where consumers will go to buy things, how consumers spend is also changing with the generations. Traditional banks like Wells Fargo, Citi, and Chase are seen by millennials and Zoomers as untrustworthy and incompetent. And there's good reason for this. Look up any major bank today and you'll find fraud, laundering, manipulation, bribery, and corruption charges spanning decades that have been shrugged off with slap on the wrist fines. Combined with a poor consumer experience, it's no surprise that younger generations would rather take their chances banking with fintech startups over entrenched banks. This lack of trust in traditional banking institutions has driven consumer interest and adoption of fintech, from online banking in SoFi and Chime to buy now, pay later in Affirm, Klarna, and Afterpay. It's not just the immoral behavior of banks, but also the legacy system in which these institutions operate that turn off younger generations. Accessing and building credit is difficult. When we started our food delivery business as 20-year-olds back in 2014, there was only one bank in town that allowed us to open a business account without fees and gave us a useless credit line of $200. We rotated buying gas every other week just to make that credit card work. When I graduated with stable employment, it took 2 months just to get approved for the Chase Sapphire Reserve card. While my income has grown and my credit score is just below 800, my credit lines have barely increased despite never missing a payment or carrying a balance. If I request an increase, Chase will do a hard inquiry and my credit score will go down, so I have no option but to wait and hope my credit rises in the future. If I ever carry over purchases on my card, I'll get slammed with 19% interest. This interest is compounded daily, so every day the balance carries over, I pay interest on both the owed balance and the accrued interest. And if I ever miss a payment, there's a $40 late fee. Credit card penalties are punishing by design to get people to repay as soon as possible. Banks make billions of dollars annually from credit card interest. The more credit card holders borrow beyond their means, the higher balance they carry over every month, the more compound interest they have to pay, and the greater the profits are for these banks. In 2019, consumers paid out $121 billion in credit card interest, and as of August 2022, Americans owe nearly $1 trillion in credit card debt. Length of credit history also makes it difficult for young people to acquire and grow credit. How long you've had your credit plays a significant role in determining your trustworthiness. If you haven't had your credit cards for 8+ years, the system automatically penalizes you for not having long enough history as a borrower. Yet because credit history is a function of time, there's little that millennials and Zoomers can do except to wait. The only other alternative is debit cards, which are inflexible as your buying power is limited to how much you have in the bank, which for most people starting out is not a lot. Because of the restrictive nature of the legacy credit system, how difficult it is to access and grow credit, the unforgiving penalties of delinquency, and constrained buying power, younger generations are turning away from cards and looking for better purchasing tools when it comes to spending and fulfilling consumption desires. As more and more consumer brands flock to e-commerce, the costs to acquire and convert customers are rising. With greater noise and limited ad space in both digital and physical channels, it's increasingly expensive for retailers to attract, convert, and retain customers in websites and stores. As a result, more retailers are forced to use discounts or promotions to drive traffic, improve conversions, reduce abandoned carts, and make their products more affordable. But discounts have a finite runway and hurt brand positioning, and at the end of the day, retailers just want to sell and move as much product as possible off their shelves. For simplicity and peace of mind, they only deal with customers who can pay for their products. For customers at the edge who don't want or can't pay the full price upfront, the overhead of financing, underwriting, managing payment plans, and collecting installments is beyond the means and capacity of most retailers. It's the shift away from cards, the appetite for better tools that enable greater purchasing power, the acceptance of fintech startups over traditional financial institutions, combined with the e-commerce gold rush, increasing customer acquisition costs, and the pressure to grow sales without discounts that have made buy now, pay later so popular with both consumers and retailers around the world in such a short period of time. Affirm, Klarna, and Afterpay are the three big buy now, pay later players who see themselves as modern, consumer-friendly successors to traditional credit cards and their predatory legacy system. When we compare these three companies, it's uncanny how similar they are to each other in messaging and products. They all position themselves as honest lenders committed to responsible spending. They downplay the money they make from interest or late fees. They talk up their retailers and user growth. They boast about their proprietary machine learning algorithms that can underwrite, assess risk, protect against fraud, and grant credit instantaneously to individuals of all backgrounds. All three companies point to their low default rates, how buy now, pay later loans are smaller and less risky than credit cards, and their healthy customer mix of prime and subprime borrowers. The products and user experience between Affirm, Klarna, and Afterpay are identical. They all actively funnel their users to a mobile app for maximum engagement and retention through push notifications. Their apps serve as centralized shopping portals that aggregate retailers, overlay over website checkouts, and manage loan payments. Rather than using your email or Facebook account, these companies tie your identity and loans into something far more personal and static, your cell phone number. And they all offer savings accounts where you can deposit cash and earn interest at higher rates than in traditional bank accounts. Creating an account was easy and took me 2 to 3 minutes at most. Affirm was the strictest and asked for my social security number and photo, while Klarna and Afterpay only needed my name, phone number, address, and birth date. With a credit score slightly below 800, Affirm gave me an opening limit of $500, teasing that it could quickly go up to $5,000 if I proved myself first on smaller purchases and on-time payments. Afterpay and Klarna were more generous, granting me the ability to borrow up to $1,000 immediately upon account creation. If I could contextualize just how easy it was to create an account and suddenly be able to borrow thousands of dollars within minutes, it really takes far more steps, effort, and time to do an online wire transfer or schedule an appointment at the DMV. Affirm, Klarna, and Afterpay offer the same core product that they call Pay in 4. With this type of loan, you can flexibly split the cost of any purchase into 4 equal interest-free payments due every 2 weeks. If you want even smaller installments for a longer period of time, up to 36 months, that's when you'll have to pay interest. The interest rate varies and reflects how trustworthy the company deems you to be as a borrower. The consumer advantage that these companies advertise is their transparency in charging simple interest on their loans and not the punishing compound interest of credit cards. Pay in 4 is buy now, pay later's claim to fame and most popular loan type amongst consumers. As long as you pay off each installment in full on time every 2 weeks, you've won flexibility at no added cost. With Pay in 4, consumers have paid the exact same price that they would have had they charged the entire thing to their credit card, the only difference being the cost is spread across 6 weeks versus 1 day. Since consumers can sign up, borrow, and combine as many loans as possible from Affirm, Afterpay, and Klarna for maximum spending power, the differentiation between all three lies in their retailers. Exclusivity is the name of the game. Retailers tend to partner with only one buy now, pay later company at a time. As a result, Affirm, Afterpay, and Klarna are in an arms race to sign as many reputable retailers as possible. While Affirm has Amazon, Peloton, and Walmart, Klarna has Lululemon, H&M, Nike, Saks Fifth Avenue, Wayfair, Sephora, and Afterpay has Nordstrom, Adidas, Gap, Tory Burch, and Bed Bath & Beyond. Their pitches to retailers are identical. Let us be your exclusive buy now, pay later option, and you'll grow your customer base, accelerate revenue, increase order sizes, and open up your business to high LTV customers who will literally borrow money just to buy your products. In the simplest abstraction, buy now, pay later companies are loan brokers building their own marketplace of consumers and retailers. Without high-profile retailers, there would be no desirable products. Without desirability, there would be no demand and then no consumer appetite to borrow money to buy products. Every time someone buys something with buy now, pay later, regardless of whether it's split into 4 zero-interest installments or 12-month installments with interest, whether or not the consumer has repaid their loan or runs off halfway through, the retailer still immediately recognizes the sale at full price upon checkout. To the retailer, a sale with buy now, pay later is the exact same gross transaction as if that person had paid with card or cash. Since retailers are paid in full immediately after each sale, they're never exposed to the loan risk or details. Affirm, Klarna, and Afterpay are left to collect and carry the bag in the event of a default. To demonstrate the arms race and the psychology of buy now, pay later, I took out loans to buy 2 luxury products I had always liked but always felt were overpriced. The first was a Dyson Airwrap. Awesome company, innovative engineering, but a $600 hairdryer is nowhere on my list of needs. The second was a pair of common projects. Classic, minimalist, white leather low tops, but $400 for a pair of sneakers is just wasteful. Dyson has exclusively partnered with Affirm, meaning the only way to buy now, pay later any Dyson product would be through Affirm. While my loan limit was only $500 to start, Affirm reran my profile and instantly allowed me to borrow up to $5,000 just for Dyson products. I got to choose between 3 payment plans: Pay in 3, Pay in 6, or Pay in 12, with the first 2 being zero interest options. Affirm clearly didn't trust me, so they limited my payment options to debit with no credit card allowed. Eager to pay off this loan as soon as possible, I chose Pay in 3. And even though I paid nothing at checkout and my first payment wasn't due until 30 days later, there was instant gratification. Dyson shipped me my $650 order the very next day, giving me immediate ownership and basically an entire month to use the product for free. Common Projects was interesting as many retailers carry their shoes, so there's no retailer level exclusivity. I first went with Farfetch, who had partnered with Klarna. Even though Klarna tells me that I'm approved to borrow up to $1,000, they continually declined to approve my $400 order with no explanation. Since Klarna and Farfetch were dead ends, I looked for another retailer with a different buy now, pay later option. Nordstrom had partnered with Afterpay, and I could feel the psychology of buy now, pay later creeping in just by looking at the Pay in 4 plan. $400 for a pair of white sneakers to me is too much, but with buy now, pay later, it's not $400, it's $90 every 2 weeks. I can afford to burn $90 every 2 weeks. That's like 2 runs to the grocery store. What a cheap shoe. Even nicer was that Afterpay let me pay with my credit card. That means every installment is posted to my credit card every 2 weeks, but I only really pay every 4 weeks when my credit card statement arrives. In less than 10 minutes, I had borrowed $1,000 to buy 2 luxury products that I didn't need. The ease of getting these loans and the small installments had diluted my brain, warping my personal budgeting and spending habits into a deceivingly liberating, seductive adventure where buying luxury goods suddenly felt more affordable than a meal at Five Guys or Shake Shack. It's a test of self-control to not buy now, pay later more frequently, especially when there's a strong incentive to continue this kind of spending. The more I pay back, the more loans I can take out, and the more money I can borrow for future purchases, and then the more expensive items I can quote-unquote afford. Luxury purchases are the last thing I should be buying these days with the coming recession. Unlike a $400 pair of common projects, a $650 Dyson hairdryer, and everything else I could buy now, pay later, what I really should be doing is investing. While the moat is supply-side exclusivity, Klarna, Affirm, and Afterpay are all fundamentally the same business, from messaging and marketing down to the products and roadmap. While they operate at different scales, these 3 companies share one last defining key characteristic: they all lose money. What money is there to make in being a broker of short-term unsecured personal loans? When the most popular buy now, pay later option is an interest-free loan where consumers are just splitting the exact same retail cost of the product into 4 installments, what profit is there for Affirm, Klarna, and Afterpay? How much of their business is centered around the late fees and interest that they claim to not profit from? And what is the endgame for buy now, pay later companies? In recent months, the big 3, Klarna, Affirm, and Afterpay, have gone from a high-flying oligopoly to a shell of their former selves. Afterpay was acquired by Square in late 2021 at the peak of the buy now, pay later hype for $29 billion. Klarna, who was preparing to IPO at $50 billion, was forced to scrap those plans since the market crash. Klarna ended up raising a massive down round at $7 billion, a massive 80% drop from its $45 billion valuation just 1 year ago. Affirm remains as the only standalone public buy now, pay later company. When it comes to scale, Klarna is the largest. In 2021, consumers took out loans with Klarna to buy over $80 billion worth of products. In comparison, Afterpay users bought out over $22 billion worth of merchandise, and Affirm users transacted a little over $8 billion. Klarna has the largest global presence, available in 45 countries today, while Afterpay is in 9, and Affirm operates only in the US and Canada. In 2021, Klarna had 145 million active customers, defined as someone who has taken out at least one loan that year. Afterpay had 16 million customers, and Affirm was the smallest at 7 million customers. Even with their most recent report of 14 million customers in 2022, Affirm is still the smallest of the big three when it comes to the user base. Klarna leads the arms race, with over 400,000 retailers signed to their platform. Affirm is second with 235,000, and Afterpay is last with 98,000. Like diplomacy, where these companies started out has had a major influence on their expansion. While the Sweden-based Klarna has the largest presence in Europe, and the Australia-based Afterpay has the most customers in Asia Pacific, the golden goose that all buy now, pay later companies chase is North America. Americans consume more than anyone else, and the United States is the world's largest retail market, accounting for 25% of global retail sales. So while Affirm operates only in the US and Canada, their top line has quickly grown thanks to their backyard advantage. In the past 3 years, Affirm has grown at insane rates to surpass Afterpay and catch up to Klarna. While Klarna has not yet reported their 2022 results, it's likely that they will continue to lead with the highest total revenue, but Affirm is certainly closing in. Since Affirm is the only standalone public company, its financials and disclosures provide us with the cleanest look into the business model of buy now, pay later. Affirm today has 5 main revenue streams: interest income, merchant fees, virtual card fees, loan sales, and servicing income. Late fees don't exist in their top line, as Affirm is the only company out of the big three with the policy of never charging late fees if consumers miss a payment. When we plot these revenue streams over the past 4 years, we can see the maturity and evolution of Affirm's business model. Let's start with merchant fees and interest income. Affirm takes a cut from the retailer for each sale made on its platform, just like a commission. While Affirm reportedly takes 2 to 5% of each sale, each retailer ultimately negotiates their own arrangement. The nuance here is that the merchant fees are generally not flat rate commissions. The percentage taken of each sale also depends on the type of loan that the customer chooses. Affirm generally takes a greater cut with zero interest loans. Let's take my $650 Dyson loan. If we assume that Affirm agreed to a baseline commission at 2% in exchange for Dyson's exclusivity, since I opted for a zero interest loan, it's possible that Affirm earned a higher commission for my order at 3%. Since retailers already pay 1 to 3% of their sales to a credit card processor for any regular in-store or online sale, giving up a few more points may feel like a fair exchange for closing a sale that would not have otherwise occurred without buy now, pay later. Interest income is the money that users pay for all the simple interest loans that they take out. This is the flywheel that buy now, pay later businesses aim for. The more retailers on their platform, the more desirable the products, the greater the intent to borrow, the more users that will come, the more loans that are issued, and the greater subset of users who will opt for interest-bearing loans, and the more interest and commission the company then makes. And if they charge late fees like Afterpay and Klarna, then late fees can be a whole nother revenue stream. With growing user base, purchasing power, and transaction volume, the end game for buy now, pay later companies is to gain leverage, demand higher commission, and grab a bigger slice of the pie for themselves. Merchant fees and interest income are the 2 largest revenue streams for Affirm, together contributing on average 85% of the company's annual revenue. Over the past 4 years, interest income has quintupled for Affirm, going from $120 million in 2019 to $530 million in 2022. Merchant fees have quadrupled from $132 million to over $450 million. This 4 to 5x growth in interest income and merchant fees is backed by the linear growth in Affirm's users and merchandise volume, which both have increased 7x in the same period. When we look at the top line for Afterpay and Klarna, we can see this same flywheel in effect. For Klarna, interest income and merchant fees are also their largest revenue streams, accounting for, on average, 98% of annual revenue for the past 3 years. Interest income has grown 30%, from $232 million in 2019 to $303 million in 2021. Klarna has more than doubled its earnings from merchant fees, going from $438 million to $973 million. Afterpay is unique in that they exclusively offer only interest-free loans. So Afterpay makes up for this lost interest income by charging retailers higher commission in the 4 to 6% range and finding customers heavier late fees. Merchant fees alone are Afterpay's primary income stream, accounting for nearly 82% of the company's annual revenue for the past 3 years, and then in 2021, contributing nearly 90% of the company's revenue. Afterpay's merchant fees have quadrupled from $200 million to $800 million in a direct linear relationship with merchandise value and customers, both of which have also quadrupled in the past 3 years. Late fees play a bigger role and represent 13% of revenue, doubling from $46 million in 2019 to $90 million in 2021. The expensive, never-ending zero-sum arms race for retailers appears to be coming to an end. Affirm and Klarna have both launched digital debit cards where consumers are no longer limited to the retailers on the platform and can now buy now, pay later just about anywhere. Consumers generate these one-time virtual cards for each purchase, load on a loan amount just like a prepaid balance on a gift card, and can pay at any online or physical store that accepts Visa. Any purchase charged on a virtual card is automatically converted into a loan and split into multiple installments, even if the retailer doesn't support buy now, pay later. In these cases, Affirm earns a portion of the credit card processing fee that the retailer normally pays out to be able to accept cards in the first place. Virtual card revenue has become a steady top-line contributor for Affirm, growing from $7 million to $100 million in 4 years, representing 7% of overall revenue in 2022. While the Big Three's business performance validates both the concept and network effects of the buy now, pay later flywheel, the reality is that the economics are simply not sustainable. Merchant fees, simple interest, and late fees combined are just not enough for buy now, pay later companies to sustain themselves. Affirm has lost over $1 billion in the past 4 years, snowballing from $127 million in 2019 to nearly $900 million of losses in 2022. Klarna is not far behind with an operating loss of $600 million, while Afterpay is $200 million in the red based on their combined 2021 results. There's an argument to be made here that if Affirm and Klarna both charge daily compound interest instead of simple interest, their paths to profitability would be significantly easier. It's easy for buy now, pay later companies to romanticize themselves as disruptors of a predatory system, but ultimately your business has to last and be sustainable in order to truly disrupt something. While simple interest is consumer friendly, it doesn't keep the lights on. To demonstrate, we can revisit my 2 loans. Affirm offered me a 12-month simple interest loan at 24% APR for my $400 common projects. The company would have made over $50 in interest income. Under daily compound interest, Affirm would have earned over $100 or double in interest income. For my $650 Dyson loan, Affirm would have made around $90 in interest from a 12-month loan at 24% APR. They would have earned twice as much with daily compound interest. Under this abstraction, if any of these buy now, pay later companies earn double their interest income by charging daily compound interest over simple interest, these companies would all be profitable today or very close to it. At the same time, Affirm and Klarna would certainly not have so many customers if their loans had daily compound interest, so this is more of a thought experiment than a foregone conclusion. The reason why merchant fees, simple interest, and late fees are not enough has to do with how buy now, pay later loans are financed. Whenever you place an item in a cart, select buy now, pay later for payment, and click checkout, you always wait a minute or so before the next page loads. While you might think that the loading is just the retailer processing your order on their backend, what's really happening is that your order is also serving as a loan application. Every time you try to buy something with buy now, pay later, you're effectively applying for a loan of that amount with Affirm, Klarna, or Afterpay. Each loan application is reviewed and underwritten by each company's algorithms, which then spit out an automated decision. These algorithms can reject your application for any reason, just like when Klarna declined to approve my purchase on Farfetch. When they do approve your loan, you choose your preferred terms, and then you end up with your loan. But that loan is funded and issued not by the buy now, pay later company, but instead from a traditional bank that they've partnered with. In the case of my Dyson purchase with Affirm, that $650 loan was funded and issued by Cross River Bank. Nearly 80% of Affirm's loans in 2022 were funded and issued by this Jersey-based community bank. Afterpay loans are funded and issued by New Zealand, Citibank, and National Australia Bank. Klarna's loans in the US come from the Utah-based WebBank. Buy now, pay later companies basically borrow money from the bank so that you can borrow money from them to buy the things that you want. This transfer of debt, or robbing Peter to pay Paul, is not a new practice in the world of finance, but it's the details that are so spicy. In the case of my Dyson purchase, Affirm's algorithms performed the underwriting and approved my loan application. Cross River Bank doesn't perform any underwriting of its own. They fully trust the decision that's made by Affirm, and then they fund my $650 loan from its own cash. Assuming in our example that Affirm's cut is 3%, Cross River Bank distributes $630 to Dyson as the sale amount net of merchant fees and then sends the remaining $20 to Affirm as commission. Cross River Bank now has a $650 loan in its records. As a customer, however, I owe $650 to Affirm and not Cross River Bank. This is because Affirm is contractually bound to purchase and take ownership of this loan from the bank within days of its creation. The bank didn't perform the underwriting or have any exposure to me as a borrower, so they don't want to hold on to my loan any longer than necessary. But since Cross River Bank is the one who makes this entire transaction possible, they naturally want to be compensated for fronting the cash, funding the loan, and distributing payments to all parties. So after a few days, Affirm takes over the $650 loan by purchasing the loan at face value and paying an origination fee to the bank for their troubles. The installments that I pay as a customer then go directly to Affirm so that they can make whole. If I don't pay, then Affirm comes chasing after me so they can get their money back from this loan. These are the behind-the-scenes transactions that take place between traditional banks and buy now, pay later companies that made my $400 sneaker loan possible and supports every single purchase that's made every day and every hour by customers using Klarna, Affirm, or Afterpay. The reality is that with these funding arrangements, Affirm and buy now, pay later companies actually lose money on zero-interest loans. With no interest to collect and inclusive of the origination fee, the purchase price that Affirm, Klarna, and Afterpay pay banks for zero-interest loans exceeds the actual fair market value of the loans themselves. This is an unavoidable cost of business for buy now, pay later companies to the extent that Affirm has an entire category dedicated to this expense called loss on loan purchase commitment. Affirm's annual losses on zero-interest loans have grown from $73 million to $200 million as customers have grown and more loans have been issued in the past 4 years. Loss on loan purchase commitments represent on average nearly 20% of Affirm's annual operating expenses. So if Affirm and other buy now, pay later companies lose money on pay in 4 and other zero-interest loans, which also happen to be the most popular amongst consumers, then why do they keep offering this option? The answer is in vintage. In banking, vintage is a measurement of the quality of credit and returns in a loan portfolio based on historical losses and default rates. Based on vintage, one can forecast future risk and extrapolate the quality of borrowers in a loan portfolio. Affirm, Klarna, and Afterpay are essentially building and managing these annual billion-dollar portfolios filled with millions of short-term unsecured consumer loans every year. If their portfolios were mostly filled with high-interest 12-month loans, then on paper these portfolios would have good returns, but they would also bear significantly higher risk and suggest that a majority population are subprime borrowers. Subprime borrowers pay the highest interest on loans in general. If payments are made in full and on time, then subprime interest-bearing loans naturally become the most lucrative assets for Affirm, Klarna, and Afterpay. But lending to too many subprime borrowers is the equivalent of building on quicksand. If the bubble bursts and the majority of buy now, pay later loans were issued to subprime borrowers who have no means to pay, then these billion-dollar loan portfolios will become worthless. To prevent such a disaster, buy now, pay later companies must cultivate a healthy population of prime loans to balance the subprime loans. Prime borrowers are individuals with good credit history and considered the safest and most likely to repay their loans in full and on time. But prime borrowers are not the target of buy now, pay later services, as they generally already have adequate access to credit or possess the means to pay for such purchases in full. So to attract prime borrowers and to balance out the subprime loans in their portfolio, which must be many, Affirm and other buy now, pay later companies continue to offer zero-interest loans at a loss to maintain stability. This is why savings accounts have become such a big priority for buy now, pay later companies. Affirm and Klarna actively push consumers to deposit funds into their high-yield savings accounts with no fees or minimums. If customers deposit their cash with Affirm or Klarna, then these buy now, pay later companies can use these deposits to fund loans instead of relying on Cross River or other banks to do it for them. By becoming the lender and not just the broker, Affirm and Klarna can avoid losses on zero-interest loans, eliminate origination fees, and improve their transactional economics. Ironically, using balance sheet deposits as funds to advance loans to customers is a page straight out of the traditional banking playbook. In 2022, Affirm funded 20% of all loans through customer deposits rather than through Cross River Bank, which consequently reduced their loss on loan purchase commitment by $40 million year over year. It would be of no surprise if Affirm's long-term goal is to increase the percentage of self-originated loans to as high as possible in the coming years. Since simple interest and merchant fees are not enough to sustain the business model, Affirm has two final revenue streams that it's aggressively investing towards in the pursuit of profitability. The two are loan sales and servicing income. Every year, Affirm packages a portion of the loans in its portfolios and sells them as securities to investors. Affirm remains as the loan servicer responsible for administration, customer service, and collections, so in their words, they can quote-unquote control the user experience end to end. Affirm charges the investors that buy its loans a regular servicing fee. So loan sales and servicing fees go hand in hand together, and both revenue streams have grown from $5 million in 2019 to over $250 million. Loan sales and servicing fees accounted for 15% of Affirm's total revenue in 2022. While lucrative, the securitization and sale of subprime loans brings eerie parallels back to the 2008 subprime mortgage crisis. The 2008 housing collapse and subprime mortgage crisis was due to many of the same core elements that are present in buy now, pay later: access to cheap credit, excessive spending, overextension of subprime borrowers, and unregulated lending standards. While there is a difference between a loan for a $400 shoe versus a mortgage on a $400,000 property, buy now, pay later companies continue to move in a worrying direction that feels all too familiar. Packaging and selling subprime consumer loans as securities to Wall Street is a slippery slope, especially in a time where the market has tightened, cost of capital has increased, and buy now, pay later companies are desperate to turn a profit. Affirm admits that if the economy does take a greater turn for the worse, borrowers would first default on these short-term unsecured personal loans. In a crisis, borrowers will naturally prioritize the other loans, like their mortgages and credit cards, over buy now, pay later purchases. While the next recession is never the same as the last, the core ingredients and dominoes that lead to an economic contraction are always consistent: artificially inflated spending, consumption beyond means, excessive debt, unsustainable growth, and asset bubbles. Yet in the face of inflation, layoffs, reduced production, and increasing interest rates around the world, consumers continue to spend at record rates rather than cut back on consumption. While the billions of dollars in merchandise purchased every year with Affirm, Klarna, and Afterpay is not at the same trillion-dollar scale that subprime mortgages were at in 2008, the reality is that the underlying consumer behavior that buy now, pay later promotes is still very much part of the problem. What's equally scary is to see the continued expansion of buy now, pay later into other categories such as rent, groceries, healthcare, B2B, and even car repair. Affirm, Klarna, and Afterpay all argue that they communicate everything upfront, and they shouldn't be penalized for providing tools when every action is ultimately still made by the consumer. Regulators counter that transparency and calling out the risks have never been enough to protect consumers from themselves. So buy now, pay later raises deeper philosophical questions around human nature. Do people know what's good for them? And if humans don't know how, or can't be trusted to be responsible, then who should be the one to put in safeguards to prevent these natural impulses of greed and overconsumption? When we look at the stance that different governments have taken with buy now, pay later, it's fascinating to see the contrast between Western individualism and Eastern collectivism. On one end, you have China, who says that humans and corporations can never be trusted to make responsible decisions. Chinese regulators have ruthlessly cracked down on Ant Financial, the biggest buy now, pay later company in China, and have turned its unsecured personal loan business into a state-owned venture where lending decisions and user data are regularly shared with their central bank. And on the other hand, you have the United States, who has long favored corporations over consumers and predictably opted for a wait until it falls over approach with buy now, pay later.